Hello, everyone, and welcome to BDO's Financial Reporting Update webinar. My name is Raisa, and I'm joined today by Anthony, who I'm sure is a familiar face to many of you, and we are part of BDO's Technical Financial Reporting team. We expect today's webinar to last approximately 50 to 55 minutes, including some Q&A. If you would like to ask any questions, please use the Q&A function, which you can access from the icons at the bottom of your screen. Time permitting, we'll try to answer the questions during or at the end of the webinar, or we'll get back to you after. Please note that if you click on the option to send your question anonymously, then we won't be able to contact you after the webinar. A recording will be made available online of the session, and this session is appropriate for CPD self-certification. All right, so that's it for our housekeeping today. Let's have a look at what's on the agenda. So we'll start off with our financial reporting update, specifically looking at the amendments to IAS 1 on the classification of assets and liabilities as current or non-current. We'll then look at some developments in the other corporate reporting space, so looking at the revised UK and QCA corporate governance codes. And then we'll end off with messages from regulators, specifically looking at the FRC's areas of supervisory focus. And with that, I'll hand you over to Anthony to kick us off on the financial reporting update.
Thank you, Raisa. Good morning. Is it still morning? Yes, good morning, everybody. This financial reporting update, as Raisa said, I'm really just going to focus on one set of amendments. Some amendments that have had a very troubled start to life, and I think chopping and changing of them has led to some confusion, but we now know exactly what we need to do. And we need to do it this year, applying IFRS. So just on to the next slide, please. Sorry, and on again. So this amendment to IAS 1, and what this is all about is when do you recognise liabilities as current and non-current, specifically in a situation where there are covenants or conditions set that determine whether the liability becomes repayable earlier than the term date. So we're really talking about loans and the like with covenants. Now, as I said, these have had a rather troubled start in life. There were amendments issued as far back as January 2020. Those amendments were finalised, and then June 2020, people started thinking about how they might apply, what effect they might have. That raised a few concerns and kind of raised eyebrows. Once I really thought about, does it really mean this? And in response to those questions, someone made a submission to IFRS. IFRS looked at the question and said, well, actually, yes, that is what it means. But we probably shouldn't have done that. The ISB probably shouldn't have done that. And certainly, you know, when the tentative agenda decision was made, stakeholders pushed back and said, well, if that's the outcome, you really need to go back and change these amendments again. So in 2021, they issued some new amendments, some proposals for new amendments, and after some debate and tweaking and simplifying, amendments were finally issued in 2022. And so that tells us the state of play today. That they're the amendments I'm going to look at, and they apply. They're effective for years commencing 1st of January 2024, so December 24 year ends. So despite the history, we now know what we need, and we know we need to do it this year. So let's move on to the next slide, please. So what this is all about is trying to determine when you have the right to defer settlement beyond 12 months. So in other words, making it non-current. Or if you don't have that right to defer settlement, you could be forced to repay within 12 months. Then the liability is current. So they've redrafted a few paragraphs and amended a few paragraphs within IAS 1. And the first of those specifies that you have a right to defer settlement. In considering whether you have a right to defer settlement, you must consider whether that right has substance and exists at the end of the reporting date. That's a slight change from what we had before, where it used to talk about a conditional right. And to be honest, it was that word conditional that led to some challenges. If you think about it, any loan that could become repayable at an early date if you don't meet the terms and conditions of the loan. They're just standard terms and conditions of paying interest when it's due or making repayments when they're due. So it's that word conditional that people were challenging. And so that's been removed. And now it says the right must have substance. Yeah, you can enforce it, and it must exist at the end of the reporting date. It must exist on the balance sheet date. And you then, if there is any further conditions, then you must consider whether that an assessment of that, if those conditions affect the classification. So look at covenants. Would it change the classification? Could it make the liability current? Importantly, whilst this was always there, and they've made it explicit now, this is about the right. It's not what you intend to do. So if you do intend to repay a loan early, you do intend to repay it within 12 months, despite having the right to defer, it's still non-current because your intention or your plans don't change the classification. So it's not affected by the likelihood of you exercising any earlier right. It's also looked to clarify the meaning of settlement. And this really comes to the fore when you've got convertible debt. So debt that could be converted to equity. So we can move on to the next slide and we'll get to the heart of the issue, which is about compliance with covenants and what assessment you need to make there. Well, the first one is compliance with that covenant required on or before the end of the reporting period? You might have a test coming. Let's say you've got a December year end and you know there's a test due based on the financial position at the 31st of March. Well, that isn't required before the end of the reporting period. So the answer to that question would be no. It's only relevant if it relates to financial positions before or at the end of the reporting period, not after it. So if it's a future test, you can ignore it for the purpose of this assessment. If it's a test relating to the balance sheet before the year end or performance before the year end, well, then that does affect the right to defer settlement. But importantly, even if you actually get round to doing the test post balance sheet day, think there about the classic example where it's about your financial position on the 31st of December based on your audited accounts. Well, you won't actually have the audited accounts until after the 31st of December. That's just the date you are performing the test. But the relevant date for the test was on or before the end of the balance sheet date. So it's what's the relevant date for the data, not the date you actually get around to doing the test. So we can ignore future tests. So we can ignore tests related to future dates, but we must include all tests that relate to the current period, even if we even if we don't perform the test itself until the later date. Moving on, please. Now, one thing that's been brought into sharp focus here, and this may seem a bit pedantic, but it is actually central to try and understand where we are now, is a distinction between a bank providing you with a waiver and a bank providing you with a period of grace. Now, what's meant by a waiver is to say that they just surrender their rights to take action against you when you failed a covenant. So you had a test before the year end. Before the year end, you spoke to the bank, and the bank said, "Look, it doesn't matter. We won't enforce that breach of covenant. We won't take any action against you. We surrender the right to do that. That's a waiver." That contrasts with a period of grace, where in the same situation, you've breached a covenant, and you go to the bank, and the bank says, "Okay, we won't enforce that particular breach, but we reserve the right to do so." Yeah, we won't enforce it between now and some future date. That's a period of grace, but at that future date, we could still do it if we wanted to. So the point is, they've retained the right to enforce the waiver, to enforce the breach. They've just said, but we won't do that for a set period. That's the difference between a waiver and a period of grace. Now, why does that matter? Well, a waiver is an all or nothing thing. We can forget about that breach now. But a period of grace means that breach is still in play. And if you look there to paragraph 75, the only time that a period of grace would change the classification would be if that period of grace was in itself for more than 12 months after the balance sheet date. So they've committed to not doing anything about this breach for the next 12 months. They might do it in 12 months and 1 day, but they can't. They've said they won't do it in 12 months, so it's no longer current. And if they've given you a waiver, they can't do anything about that breach at all. They've surrendered their right. It just disappears entirely. If, however, the period of grace was only 3 months, they can enforce it within 3 months. The classification remains current, doesn't become non-current on the basis of that period of grace. I hope that's clear, but it is a centrally important notion between the bank just waiving its rights and the bank just suspending its rights for a period of grace. So we can just move on to the next slide, please. And so then these ideas get encapsulated in this little flow chart. So if you've got a waiver for the covenant breach before the end of the reporting period, well, that breach can now be ignored. And if there's nothing else relating to this period, it's non-current. And the answer to that question is yes. You flip all the way to the bottom because that's an absolute surrender of their rights to require settlement. And the answer is no. You then go, well, has the bank done something which is a period of grace? You know, have they said that we won't enforce this for a period? Well, if the answer is no, you breach the covenant, you either haven't given you a waiver and I haven't given you a period of grace, it must be current because they can demand repayment. If they have given you a period of grace, though, you then look to see for how long. And that period, only if that period of grace is at least 12 months after the balance sheet date, does it push the settlement beyond 12 months. So the answer to that question, is it more than 12 months, is yes, it's non-current. But if it's less than 12 months, the answer is no, it falls back to be current. I think historically, we didn't really have that level of precision on what was meant by period of grace, but we do now. Importantly, if someone gives you a waiver and says we will test again in 3 months, that is now a new test because they've waived the old one. This was a completely new test, and if that is beyond the reporting date, you don't have a breach, you don't have a covenant that's relevant to this year. But if there's a period of grace and it ended with a test in 3 months, well, no, once that is a new test, the old test is still in play as well. So even if you pass the new one, if all they did was give you a period of grace, they could choose to enforce on the one you did fail. So again, it has an interplay with any further requirements they set as well. Let's just see that in a few examples. Firstly, here we take a loan. It's a bullet loan repayable after 5 years. That is a covenant, which is that we must have a working capital ratio of 1:1 on every balance sheet date. And if we fail that capital ratio, the bank can demand repayment. We have a 31st December year end. At the 31st of December X1, the ratio is 1. And so we breach the covenant. We issue our accounts on the 20th of February. But they give us a receipt, they give us a waiver of the covenant on the 15th of January. So we aren't, by the time we've issued the accounts, we know we're not going to have to repay this early because they've waived it. Do we classify this as current or non-current? Next slide, please. Well, think about it. Was compliance required at the end of the period? Yes, it was. Did we receive a waiver? No, we didn't receive a waiver by the end of the reporting period. So even though we got one subsequently at the balance sheet date, that was technically a current liability. There is no period of grace. So the answer to the next question, in the flow chart on the right is no, so we land in current. We had a covenant that was required by the end of the reporting period. It did affect the right to defer settlement, going down the left-hand side, and we've breached it. So waivers will only have an effect if you get them before the balance sheet date, or else they haven't changed the balance sheet date classification. Next example, please. Beginning of the year of December, we can see that we think we're going to breach the year-end ratio. We think we're going to get to be 0.9. In anticipation of that, we go to the bank and tell them about this. And on the 15th of December, they give us a waiver. I remember, by a waiver, we mean they've surrendered any rights to take action against us for the expected breach. We will test again within 12 months of the year end. Do we classify this as current or non-current? Next slide, please. Well, the left-hand side remains the same. We need to think about whether there is a covenant, affect the settlement. Let's assess that breach. But the answer to the first question on the flow chart on the right, have they provided a waiver by the end of the reporting period? Yes, they did. They give us it in the middle of December. They surrendered their rights, so we have a right at the end on the balance sheet date. That right at the balance sheet date exists that permits us to defer settlement for 12 months. There is another test to come within 12 months, but that does not affect the assessment at this point in time. It's only those tests before the year end. So in this case, the answer to the first question is yes, and we flip all the way around to non-current. Third example, please. In this case, everything else is the same. We have a December year end, but the test is based on the 31st of January position each year. Before our balance sheet date, before the end of December, we look forward, we think we're going to breach that. We think it's going to be 0.9 on the 31st of January. And whether or not it was met, the issue is what's the position at the balance sheet date. So moving on to the next slide, please. Well, is this compliance required on or before the end of the reporting period? No, it relates to the financial position at the end of January. And there's a knowledge bomb here. January comes after December. So the answer is no. It wasn't required before the end of the reporting period. So even though we at the balance sheet date think we're going to fail it, or indeed if we did subsequently fail it, it doesn't matter for the classification at the balance sheet date because it doesn't apply to it. Non-current in that case. And now my final example. We have a loan at the end of December. There is an annual current ratio covenant test, which is based as at November. If we fail to meet that covenant, they have the option to demand immediate repayment at any time until the next covenant date. We do breach the one at 30th of November X1, but the bank says it won't exercise its right to demand the loan until the 30th of June X2. The lender, and on top of that, the lender introduces a new current ratio covenant test, which they will look at the 30th of June. And the lender says they will reconsider the loan based on that new current ratio covenant. From the 1st of July X2, the lender will have the right to demand payment with respect to the 30th of November X1 covenant violation. Now that wording is all very detailed and elaborate. What do we take from that? They give us a period of grace. They didn't surrender their right to exercise against the breach on the 30th of November X1. They just said, we won't do it until any time before the 1st of July. We'll do another test then. But really, it doesn't matter how you turn up in that test. Even if you pass the 30th of June test, they could still exercise their right for the earlier failure because they only give you a period of grace. I think I probably set us up to understand what the answer to this one will be. So look at the next slide. Did they give us a waiver? No, they didn't fully surrender their rights to demand repayment. Did they give us a period of grace before the end of the reporting period? Yes, they did. So we need to consider the length of that period of grace. Well, the period of grace was only until the end of June. That's only 6 months after the year end. So it's not. So the answer to the next question is no, the standard remains current. And it would have been easy to think, oh, well, there's a new test. It's best at the end of June. That's the one that matters, and that doesn't apply at the balance sheet date. So it must be non-current. Well, that would have only been the case if they'd completely surrendered their rights to enforce the earlier breach, and they didn't. And that meant you didn't have, in substance, a right to defer settlement for 12 months. So hopefully that explains these new changes, stresses the importance of knowing exactly now what a period of grace means, and to be able to distinguish that from a waiver. It's about the bank's absolute surrender of its right to enforce compared to suspending its right to enforce. And they can lead to different outcomes if the period of grace is less than 12 months. So that's set of amendments. They apply now, years commencing 1st of January 2024. So be thinking ahead for what it might mean for reporting at your interim and balance sheet dates. Okay, we can move on then to some other corporate reporting matters. And more specifically, the revisions to the 2 key codes on corporate governance in the UK. So next slide, please. First one is looking at the Quarter Companies Alliance Corporate Governance Code. Now, this tends to be for smaller companies, or at least those which are listed on AIM, and are commonly used as well by large private companies who are following corporate governance codes now, according to the Companies Act. So this isn't for fully listed who use the FRC's corporate governance code, but it is used by the vast majority of AIM businesses, and indeed the majority of large companies who claim compliance with any corporate governance code. So let's move on and look at what they've done with this. The last QCA code was in 2018, so this is the first update for about 5 years. And in the meantime, expectations for what is good corporate governance practice have evolved, and they've looked to keep up with that. There is a new principle on remuneration, but they've managed to keep to 10 principles in total, basically by merging 2 of the others. They've merged the ones on director skills and governance structures and merged them into one. Hence, there's still 10 principles despite the introduction of a new one. What they've done is place much greater focus on purpose. This has been something the FRC have really pushed on over the last 5 years or more, and the QCA code is now trying to reflect that too. What is your purpose? And in thinking about that involves considering your interactions and your relationships with stakeholders and environment, etc. And as we also see a great focus around sustainability and communication with stakeholders. And then the final piece is being a bit more explicit about risk management. So that's the change in terms of the principles of what good corporate governance is. And what the revision also does is include some new disclosure requirements, both in terms of the annual report and others that can be done on the website, but certain new mandatory disclosures or new expected disclosures. This is effective for periods beginning on or after the 1st of April 2024. Although there is a transitional 12 months, what that's basically saying is, if you have within the first 12 months or the 12 months to March 2025, they would expect you to report against the new code. They could see that you might have to take that. It might take 12 months for you to implement all the changes to the corporate governance procedures. So any reporting would explain the process to date and how you were going to fully comply by the end of that 12-month transitionary period. Next slide, please. In terms of the additional annual report disclosure requirements, here they are. Firstly, I say this focus on purpose and culture, so describe that. that purpose, and importantly, how any actions that deviate from the intended culture, the purpose and culture of the business, how they are addressed. So how you're monitoring and making sure the entity as a whole lives up to that stated purpose and culture. Risk management, now requires additional disclosures to explain what you do to manage risks, including climate-related risks, and how you seek assurance that internal controls are effective. Now, we'll see that's a key feature of the new FRC's code for fully listed businesses. But in that case, it goes much further. This is just about how do you look to see that internal controls are effective, rather than an elaborate statement about remuneration, how in determining remuneration policies and remuneration structures, that design helps support the delivery of the purpose that we're now talking more of the business culture, and indeed, importantly, the business model and strategy. So how are those features, how are those ideas incentivized, if you like, through the remuneration structure? More disclosure around sustainability, environmental and social considerations, asking for both quantitative and qualitative disclosures on those, where they are material to the company's purpose and strategy. So if you say that sustainability is a key part of your culture, that will require you to provide more data. And so what's the culture, and then provide data that helps support it. More on board capabilities, diversity and succession planning, explain the mix of skills, experience and diversity that makes the board successful. And in terms of communication with shareholders, reflect on challenges experienced in those relationships and how they've been addressed. So some detailed disclosures for the annual report. And for me, it is significantly more than the QCA code used to require in the report itself. So one to look forward and plan to this year if you apply that code. If on the other hand you apply the FRC's code, well, let's move on to the next slide. And again, please. So this was a revised version of this was issued in 2024. They weren't developed in tandem by any stretch. I'd say more the QCA code looked back on some of the thoughts of the FRC over recent years and code changes they've made. The FRC's code is still, at the forefront. This will be effective next year for years commencing 1st of January 2025, except for the big one, which will be 1 year later. The others I'll come back to in a second, but let's focus on that big one. And the one will be effective from 1st of January 2026, these new internal control disclosures. Ahead of this code change, this was going to be a big feature. So was audit policy, and so was a resilience statement. Those areas needed legislation, and the government withdrew their draft legislation last year. So those parts of the proposed revisions to this code were taken out, and that left really just this one of them. This is the one major issue. So what we now need to do is provide a description of the board has monitored and reviewed the effectiveness of the risk management and internal control framework. So a much fuller description of how you go about doing an effectiveness assessment, rather than just saying the conclusion of it. Importantly, not just financial statement internal controls, but risk management as well, which could include operational controls. And secondly, an explicit declaration of the effectiveness of the material controls within those frameworks. So that is the new declaration, which is certainly stronger than required in the past. And where any of those material controls have not operated effectively, what action you've taken or proposed to take to address the issue, to address the ineffective material control. That I think is that will be quite a challenge. what is meant by material controls in this instance, what is a material control over operating matters, and when does it trigger disclosure. I think that there isn't really a clear, isn't self-evident what those mean. But thankfully, they have issued new guidance, and that guidance will be, it's now available electronically, and it will, the aim is this will be live and it will develop in response to as issues arise. So if you want more guidance, the FRC's website includes some, but I think practice will develop on these new ideas. One thing to note, there is not any mandatory external assurance needed. There were calls for it from some quarters. The FRC, the government first held back from that going that far, and indeed now the FRC have. And really, it will be down to the boards to determine what assurance do they, as board members, feel they need in order to make these declarations. They might be able to rely on the internal audit, or they might feel the need to bring in an external parties to review the effectiveness of those controls. Moving on then, please. And we can just quickly look at some of the other things. New principle C, which is the key word in that is outcomes. They want you to not just talk about governance processes, but what effects did that have? What were the outcomes of board decisions? Second one is extended some of the references to culture, but particularly it is now added for them, boards should assess and monitor how the desired culture has been embedded. So don't just say what you think the culture is, say what you're doing to embed it. On to the next one, and the amendments to Principle C. This used to kind of identify specific groups or groups with specific characteristics. They removed that, but now says, board appointments should promote diversity, inclusion, and equal opportunity without drilling down onto whether that's on the basis of sex or race or other identifiable characteristics, but saying this should be a broad assessment across all things, all such differences. And then in terms of provision 23, new disclosures around initiatives to address diversity and inclusion within the business. Next slide, please. We'll just cover the last few. Provision 25 has been amended, and that says that the audit committee should follow a document issued during 2023 by the FRC, which is a minimum standard for the way an audit committee should operate and interact with external audit. So that was voluntary when issued by the FRC. In this code, you should follow it, applying the normal comply and explain elements of the corporate governance code that just raise the status to an extent. Provision 26 requires them to disclose in accordance with that minimum standard as well. And then provision 28, don't just describe the emerging risks, but describe the procedures in place to manage them. Truth is, that was always common practice. So in a way, it's just articulating what you'd see in what we're seeing in practice for a period. I'd say the same for the next one, provision 37. It now explicitly requires directors' remuneration agreements to include malice and clawback provisions, but I would say that had always been the case. That was generally the case anyway. It's just codifying what was, in fact, not just best practice, very common practice amongst listed companies. Similarly, in the annual report, a description of those provisions, which again, most entities did if they had such clawback provisions in their directors' remuneration agreements. Okay, that covers what's in these two new codes, and staggered effective dates for them. But if they are codes that you apply, this isn't something to wait for the reporting point date. Remember, this is about the way the business is run. So you've got to take the steps to embed those processes within your governance structures. So with that, I will now pass back to Raisa, and I will look forward to seeing you again next time. Thank you. Bye.
Perfect. Thanks, Anthony. And we can move on to the next slide, please. Perfect. So now we will be looking at our messages from the regulator and starting off with the FRC's areas of supervisory focus on the next slide. Now, during December 2023, the FRC announced its areas of supervisory focus for its 2024-25 season, including priority sectors for corporate reporting reviews and audit quality inspections. Now, with regards to priority sectors, the FRC noted that they'll be focusing on construction and materials, food producers, gas, water, and multi-utilities, industrial metals and mining, and retail. Now, the banking and insurance sectors remain standard priority sectors. Then, with regards to specific areas within the annual report that the FRC will be focusing on in their reviews, they will be looking at risks relating to the current economic environment, climate-related risks, the implementation of IFRS 17, which is our new standard on insurance contracts, and cash flow statements. Now, we chatted in quite a bit of depth around the risks relating to the current economic environment, as well as some common errors in cash flow statements during our December webinar. So we've linked that here for you, and so you can go back and just refresh yourself. And so we'll be talking a little bit more today around climate-related risks and IFRS 17. So let's start off by talking about climate in the financial statements on the next slide. So when it comes to climate reporting, there's really two legs to this. The first is our front-end reporting for our listed entities. That's usually in line with the TCFD, or for other larger entities, it's the UK climate-related financial disclosure regulations. So that covers our front end, and some entities then voluntarily provide some level of climate disclosure in the front end. And then there's the financial statements themselves, so sort of the back end and what the impact on climate is there. And that's really what we're going to focus on. So while there is no explicit guidance on climate-related matters in IFRS or FRS, there is sort of an expectation that we'll see disclosures, and there are certain climate risks and opportunities that will impact a number of areas of accounting. Now, despite this expectation from investors that they want to see disclosures in the financials around climate, there was a report released just this week from Carbon Tracker that showed that around 60% of companies fail to provide meaningful information about whether and how climate risks and the energy transition impact the financial statements. And so this is definitely going to be a buzz thing that we're going to be hearing about a lot. And so in today's session, we'll look at some potential areas of the financial statements that may be impacted by climate. So on the next slide, we're starting off with looking at the risks. So no matter what type of climate reporting you're doing, so whether that's front end or back end, you start off with what climate risks and opportunities is the entity exposed to, and that is then going to drive what the impact is in the financial statements and the disclosures. So here we've listed some of the climate transition risks that may have an impact on financial statements. So starting off with an entity's own decarbonization or transition plans, because those plans could include decisions to restructure or to abandon certain business lines or to replace assets and invest in greener technology, all of which can then impact your financials. We've seen a lot of climate legislation coming out, so things like carbon taxes or carbon targets, or decisions to phase out fossil fuels or single-use plastics. So those may impact the financials. A shift in customer preference towards sort of greener or more sustainable goods or services. And then at number 4, we have the financing risk. So the ability to obtain financing, especially if you're sort of in a browner industry and lenders are retreating from that industry, or there could be an increase in the cost of financing where lenders build in risk premiums linked to climate-related matters. And then climate litigations and penalties and fines. So we've generally seen an increase in that type of litigation, and that, of course, can impact your financials. And then lastly, the overall cost of transition. So transitioning to net zero or achieving other climate targets may well impact the overall cost of doing business. On the next slide, we have the physical risks. So extreme weather events can have a number of impacts on a business, including increased insurance and maintenance costs, supply chain disruptions, resource shortages, and losses due to damage. Now, these risks are of particular relevance when considering the going concern assumption, provisions, and within forecasts and budgets used for impairment or valuation purposes. So once an entity has an understanding of the climate risks to which they are exposed, we can then determine if and how this may impact the financial statements. So on the next slide, we've given sort of a high-level overview of some of the specific areas of the financial statements that may be impacted by the various risks that we discussed on the previous slide. So starting off with PPE and impairment, physical climate-related risks and transition risks increase the risk that items of PPE can become stranded assets. So those are assets where their carrying value cannot be recovered within our existing business model. Climate-related matters can also significantly impact the useful lives, residual values, or decommissioning obligations, and possibly result in the obsolescence of PPE. These risks could be potential impairment indicators, or they could impact our future cash flows that we use in determining our impairment testing. For fair value measurement, we are seeing market participants factor climate into their pricing decisions. So, for example, currently we know that EPC ratings of buildings are driving their value. People want to buy greener buildings. And so for entities with significant assets measured at fair value, we are expecting to see some discussion on how or if climate has been factored into the valuation. Then provisions, so risks may result in additional provisions and contingencies due to potential litigation or compliance with legislation, but they could also impact your existing provisions on the balance sheet. So it could impact your decommissioning obligations or potentially the outcomes of existing lawsuits or the cost of fulfilling your existing contracts, because these climate risks can affect the estimation and the timing and amount of future cash flows. When it comes to provision, there's also been discussions at the IFRS Interpretations Committee on whether making a public statement about achieving net zero or other climate targets, whether those statements would mean that you would need to be providing for the costs relating to achieving that target. And generally, we would not expect that to be the case. So we wouldn't expect that just because you've made an announcement that you would have a related provision. So that's just something to keep in mind, and that's been sort of a hot topic. When it comes to revenue, now the underlying principles of revenue recognition and measurement within FRS or IFRS are not going to change. But what will happen is you may have to reconsider your existing judgments and estimates in revenue accounting if you introduce new products or services, or you discontinue existing ones, or you amend the terms and conditions of sale to address business model changes coming out of climate risks and opportunities. The two areas of revenue accounting where we have seen an impact from climate is really our longer term contracts, so potentially in areas of construction, and warranty accounting. So those are two just to keep an eye on. And then lastly, going concern. So we don't expect that in isolation, climate will result in an entity not being a going concern or there being material uncertainties unless that entity is exposed to severe physical climate risks. But it is something that needs to be factored into that evaluation. So we would expect climate to be considered within the going concern assessment. So for example, in the preparation of forecasts, that would include judgments on various uncertain future events and conditions, including climate-related matters. So what you might be asking yourself is, what do we expect to see, or what have we seen? So we've seen some entities give a specific note in their financial statements where they discuss climate and they say, this is how they've considered climate throughout their financials. Or we've seen entities simply just incorporating climate into the relevant notes, whether that's their fair value note or their impairment note. There really isn't a one-size-fits-all. All of those types of disclosures would be appropriate. It really does depend on what the impact is. The other thing we're not expecting to see is climate discussed relating to every line item within the financials. It really needs to be driven by the specific risks that you've identified, and that disclosure is usually in the front end. And so that's something else that regulators are really looking for and that investors are expecting, is that connectivity between what you're saying in the front end and what you're saying in your financials. So if you've discussed really significant climate risks or opportunities in your front end, then it would be expected that that would then flow through on what the potential financial statement impact is. And on the next few slides, we'll look at some examples of disclosure in the financial statements relating to climate. So on this slide, we have an extract from BP's 2022 financial statements in which they discuss the impact of climate-related risks on the impairment of PPE and how these have been factored into the calculation of their recoverable amounts. Now, specifically, they talk about the fact that commodity prices will likely impact their recoverable amounts, and they elaborate on judgments and assumptions that they've made around future commodity prices and the estimation of future carbon pricing or carbon emission costs in their value in use calculations. On the next slide, we have an extract from the Rolls-Royce 2022 financial statements, where they discuss the consideration of climate change in their going concern assessment. So they detail their stress testing and their scenario analysis that they've performed, and they ultimately conclude that there's no material impact. So again, it isn't only where we're seeing a material impact that we are expecting to see disclosures. We're expecting to see disclosures even if it was considered and ultimately then decided that there is no impact. All right, so I'll pause there for a minute. That brings us to the end of our section on climate. And next up, we'll then be discussing IFRS 17, which is the new insurance standard that is effective for years beginning on or after 1 January 2023. So we're well into the thick of everyone applying IFRS 17. Okay, so moving on to the next slide. The FRC issued its thematic review on the application of IFRS 17, and so we'll highlight some of the findings from this thematic review as it relates to corporates. So on the next slide, we note that the FRC was overall quite pleased with the quality of IFRS 17 disclosures so far. Some of the areas that can be impacted for corporates that they noted in their thematic was financial guarantee contracts, performance guarantees in revenue contracts, fixed fee service contracts, annuity arrangements, or captive insurance arrangements. So if you have any of these, this is definitely a potential impact area for IFRS 17. We did touch on a number of these in our December 2023 webinar, so you can revisit that for more detail. The other thing that the FRC highlighted in this thematic was some areas where they're expecting to see better disclosure. So nothing that we haven't really heard before. They talked about wanting to really see very granular accounting policies where there are choices within the standard, and to avoid boilerplate wording, and that we've heard a number of times. So let's look at an example on the next slide of the type of disclosure that could be provided to explain the impact of IFRS 17 on a corporate entity. So here again, we're looking at Rolls-Royce half-year report. And what they've done here is they've explained how they have gone about assessing whether there is any insurance risk in their contracts and what judgments they've applied in that assessment. And then where they've identified possible impacts, so for example, in their case, they had a parent company guarantee and they had a captive insurance company. They've then spoken about the fact that they've identified this and explained why there has been no impact from the application of IFRS 17. So if you look at this extract, you can see that there isn't an expectation that you need sort of voluminous amounts of disclosures. Rather, the disclosures can be fairly brief, but entity specific. All right, so that really brings us to the end of our messages from regulators and the end of today's session. So just wrapping up now, and we'll have a look if there are any questions we haven't answered in the Q&A. We do hope that you've enjoyed today's session. And just a reminder about our latest offering on the next slide. We have a quarterly publication called the Corporate Reporting Spotlight, and by participating in this call, you will receive the latest edition of this newsletter that really focuses on corporate reporting issues that are of immediate relevance. If you would like to receive this newsletter quarterly, then you can sign up to our mailing list, which is linked here, and you will receive a follow-up email about this. All right. We've got Moses who is manning the Q&A for us. I don't know, Moses, if there were any questions you thought might be useful for the rest of the audience.
Hi, Raisa. Well, we've had 3 questions which have been answered, but just I suppose to share them, there was a question on what happens if there's a demand for repayment because covenants are being breached post year end, but before the AFR have been issued, and if you have that situation, assuming there were no covenant breaches before the year end, the loan would still be classified as non-current. You'd have to disclose a post year end breach and setting out the details that the breach occurred and the repayment has been demanded, and there may be wider ramifications in such a situation, ongoing concern. Then we had another question on whether the new internal controls reporting is applicable to all AIM entities, and it's only applicable to entities that adopt the UK Corporate Governance Code. So if you're an AIM company but you do, let's say, the QCA code, then you wouldn't have to report on that. But if you have adopted the UK code, then you will have to report on it when it comes in. And then there's just a question about, are we going to have, are the slides going to be shared? And yes, you should receive an email, as you said, with the slides and the recording of the webinar and the link to the Corporate Reporting Spotlight in the next few days. So that's it.
Perfect. Thank you so much, Moses. And that's great. So that brings us to the end of today's session. Thank you so much for joining us, and we look forward to seeing you again soon. Thank you and goodbye.